Hi, everybody, and welcome to freethenation.com, where we seek to educate and enlighten people from all over the country about a variety of topics and issues that concern their freedom and liberties. Today's topic is economics, and we will soon be joined by world-renowned economist and best-selling author Robert Prechter, Jr. Free the Nation isn't affiliated with any of the parties. We're not Republicans, we're not Democrats, we're not Libertarians. We are independents who will support a politician or a policy based on its constitutionality and its respect for the rights of the individual person over the government or the collective. We invite our brothers and sisters from all parties to join us in an effort to restore integrity and sanity to a government that is completely insane and corrupt. I think all of you out there know, I think you feel it in your hearts, if you don't outright know it, that something is wrong with the way this government is being run. And it's not just President Obama and the current Congress. These problems go back for decades upon decades. This country, the United States, has piled deficit upon deficit, year over year on top of itself, to the point now where we have so much debt and such a high deficit that we may never be able to pay it back. That is wrong. And as high as these deficits are, they haven't kept pace with the need for public programs and with the need for wasteful spending. And as high as these deficits are, there's a higher deficit. And that higher deficit is the education deficit. The Founding Fathers knew very well that without an educated electorate, the principles spelled out in the Constitution and the Declaration of Independence would never stand. That people would be tricked and lied to and fooled into accepting fewer and fewer freedoms. Today, freethenation.com will begin to create and provide a forum where we can all share our knowledge and education on the principles of liberty, freedom, economics, history, in the United States Constitution and the Declaration of Independence. We look forward to you joining us on this journey. And today's guest is Robert Prechter, founder and CEO of Elliott Wave International and best-selling author of the book Conquer the Crash, which predicted accurately many of the problems we've experienced in the economy over the past year. Hi, Bob, and welcome to Free the Nation. We really appreciate you taking time for us today.
Yeah, my pleasure.
So, Bob, many economists like Peter Schiff and Mark Faber are predicting a collapse in the U.S. dollar based on inflation of the money supply, unfunded liabilities, and runaway government budget deficits. In your September Elliott Wave Theorist, you're calling for a major rally in the dollar. What do you feel the reasons are that the dollar will rally given all of these downward pressures?
There's always a fundamental story at a turn. And when the dollar was making its high last March, nobody was talking about this sort of thing. As soon as it started to fall, and particularly started picking up in June of last year, everybody started jumping on the hyperinflation bandwagon. And in the past month and a half, we have had two instances where the percentage of traders bullish on the dollar got down to 3%. That was even lower than it was when the dollar made its lowest reading about a year and a half ago. This kind of lopsided opinion almost always yields a move in the other direction. Now, that's the technical side of things. On the fundamental side, I think the people who are calling for hyperinflation have got it backwards. What we have started in 2008 is the biggest deflation ever to hit a monetary system in the history of the world. And the first shot across the bow was the decline by more than 50% in the commodity indexes, the stock indexes, and almost that much in the very bulled-up real estate areas. I think the problem is not money, even though the Fed has created $1 trillion worth of new money, trading it for debt in recent months. That pales in comparison to the amount of bad debt that's out there. There's over $50 trillion worth of dollar-denominated debt, hundreds of $1 trillion worth of derivative promises. We've got Social Security and Medicare promises. All of these are IOUs. And the problem is that the system is way oversaturated with IOUs that nobody can pay. And that is psychologically part of, and in fact most of, the money supply. People who've got these IOUs think they have a certain amount of value in their vaults, and they don't. And what we're doing now is we're in the process of making manifest what's hidden from everybody, which is that all of these IOUs are worthless. And that's the engine of deflation.
But the administration and the Fed have shown that they're pretty much prepared to do anything it takes to keep asset prices high, including cash for clunkers, cram downs on mortgages, bailouts, 0% interest rates, monetizing the debt, and trillions of dollars in stimulus. In spite of these inflationary devices, do you think it's still possible that we could see a major deflation in the United States?
Absolutely. It overwhelmed it last year, and every couple of days the Fed would announce some new program. Do you remember the time when the top 5 central banks in the entire world got together and said, basically, we're going to make all the credit available at 0% interest that anybody in the world wants? And the market kept collapsing. None of this matters. What happened in March was we got another extreme in sentiment. We turned bullish in late February and said we're going to have a very sharp, scary rally for anybody who's bearish. You need to get out of the way. That was due to the extreme, not only a beautiful Elliott wave count from a technical point of view, but the extreme negative sentiment. We had only 2% bulls among traders there, and some guys that have been bullish their whole careers were turning negative and saying it was the worst since the Great Depression. So this is a completely natural rally. It's just like the rally following the 1929 crash. And as far as I'm concerned, it's exhausted. It's gone right to our target zone. We had 1,100 1,000 to 1,100 in the S&P as our upside target area, roughly speaking. We're deep into that now, and I think the market is getting very tired. I also think even though the dollar's made new lows in the last week, poking down to a new low almost every day, we failed to see a new high in gold and silver. I think those are getting very, very tired. So I think we're on the cusp of a really dramatic change in the other direction. I think the dollar's going to go up for a year, stocks are going to go down for a year, and commodities will probably join them on the downside as everything revalues in dollar terms.
And I think that call you made in February was one of the I think that was one of the biggest calls in the history, wasn't it?
Well, I was happy to do it because people were calling me a perma bear, even though I was a perma bull in the 80s, supposedly. I think I changed, but this is of such great magnitude. The top that we built was so huge from the 2000 peak to the 2007 peak. We've never experienced anything like it. And we've got records of English stock prices back to 1695. There's absolutely nothing this big. And when A.J. Frost and I wrote our book called Elliott Wave Principle back in 1978, we said, look, there's a great, great bull market coming, but it's going to be the last leg up. And it's going to be a mania. It's going to be like the 20s. It turned out to be 3 times as big as the 20s. And one of the greatest manias of all time. And it's going to take years to unravel the excesses of what happened there.
My next question is, how do you see gold specifically reacting to what appears to be the inverse pressures of credit deflation and the inflationary policies of the government that we mentioned earlier? And, Bob, what's your target and timeline for a bottom in gold?
Well, here's something I think is very important. If you go to any gold bug website, you'll see a chart of the dollar and how it's lost 97% of its purchasing power since 1913 when they created the Fed, right? Mm-hmm. Okay, that means essentially that anything that was priced in 1913 should have gone up 30 times simply because of the pressures of inflation. But if you look at the price of gold, which was $20.67 an ounce in 1913, in fact, it was at that price for 100 years, it's gone up 50 times in value. So you could make a case that gold has actually gone up more than everything else. Now, I wouldn't push that too hard because maybe the graph is off a little bit and actually the dollar's lost 98% of its value, in which case gold is completely fairly valued against everything else. But my argument is the only way you can be bullish on gold here is to believe that there will be a massive additional inflation. And I think that the inflationary forces of the past 76 years, since 1933, are completely exhausted. And we're now in the process of everybody throwing up their hands and realizing they can't pay any of the debts. So that's why I am not one of these people who thinks that gold is going to go to $10,000 an ounce or we're going to replace all the money with, $50,000 an ounce gold. Our target was basically the old highs, which was 1033 in 2008, March 08,